In the current era, 8 interconnected trends or cycles are either reaching the end of their run or reversing. And these include, number 1, central bank distortion or manipulation of the markets. Number 2, the business cycle of credit or the debt expansion and contraction. Number 3, the yield or the interest rate cycle. Number 4, the commodity cycle. Number 5, the stock market cycle. Number 6, regulation. Number 7, globalization. And number 8, demographics. And today we're going to take a look at only a few of these areas for a little bit of introspection. We all need to ask the question, what happens next? So let's take a look. We're looking at the Goldman Sachs Commodity Index S&P 500 ratio, and it shows the relationship between equities and commodities. And as you can see by the chart, it really doesn't matter whether equities are expensive or commodities are cheap or vice versa. What matters is at each extreme, it seems to be a prelude to a problem. Going all the way back to 1971, we can see that the first crisis was the oil crisis in 1973-1974, followed by the Gulf crisis in 1990, the dot-com bubble in 1999-2000, the Great Financial Crisis in 2008, and we now find ourselves at another extreme, with commodities being very cheap here in 2018. So what's next? When it comes to the timing of the next recession, there are a few signs that are better to investors than the shape of the yield curve. And a flattening yield curve may be a result of long-term interest rates falling more than short-term interest rates or short-term interest rates increasing more than long-term rates. And a flat yield curve is often an indication of a recession or a bear market. And one reason that the yield curve may be flattening is that people expect inflation to decrease, or in this case, it's because the Federal Reserve has been raising interest rates. And this chart here you're looking at is what's called the 2s and 10s. And it's simply a measurement of the difference between the yield on the 2-year and the yield on the 10-year. And the flattening of the curve has been happening since about 2015 as the Fed has been hiking interest rates. And so now the 2s, 10s have a yield separation of about 50 basis points. So that's 50 basis points from a possible inversion, at which point you start the countdown to a recession or a bear market. And I think that the argument would be valid if you did say that the central bank was distorting this yield curve by playing with the 10-year yield in their funding and quantitative easing or quantitative tapering. It's a valid argument. So let's go to another chart. And this chart here is the spread between the 3-year and the 2-year, the spread being, again, the measure of the difference of the yield between the 3-year and the 2-year. And this chart is showing somewhat the same as the 2s, 10s, but the difference here is that the 3-year and the 2-year, they're much less susceptible to central bank distortion or manipulation of the markets. And as you can see, that the spread was 0 at the beginning of 2018, just right before we had the first correction. And then now it had a bounce and came back down, and we're at 0 once again. So the question is, what happens next? And this last chart here from Bloomberg, which is labeled the Market Message Indicator, and it tracks various different data points, including how the stock market is performing relative to the bond market, cyclical stocks relative to defensive stocks, corporate bond spreads, the copper to gold price ratio, and the US dollar index. And as you can see here, that we hit a peak in January of 2018. And that's indicating that the level of investor confidence and aggressiveness across all the financial markets, as we discussed, is just about as high as it was back in January of 2000 and June of 2007. And what's also important is that even though we've had a lot of chaos here in early 2018, the measure has barely dropped. So we're still at relatively high levels. So the question becomes, what's next? Well, hopefully we'll be able to answer that in future videos. But for today, that's ChewDog Charts. Thank you.